our panel. We've got Andrew Hall, who will be first up. We've got Paula Jarzabkowski as well from the University of Queensland, and we've got Carolyn Schuster as well. So very good panel. I'm going to invite Andrew Hall up first. I'll just briefly introduce Andrew to you all. So Andrew is the Executive Director and CEO of the Insurance Council of Australia. Andrew has served as the Executive General Manager, Corporate Affairs for the Commonwealth Bank. He was responsible for the management of CBA's corporate reputation, public affairs and sustainability. He was previously Director of Corporate and Public Affairs for Woolworths Limited, overseeing a similar portfolio and participating as a member of the management board. His expertise has been recognised with admission to the Arthur W. Page Society, recognition in the International Top 50 Corporate Affairs Professionals, and in the inaugural award of the Top 50 Outstanding LGBTI Leaders in Australia for his work in leadership roles, diversity, and on the board of Equality Australia for the Marriage Equality Campaign. He has extensive experience in governance, both in the corporate and not-for-profit sectors. He serves on the board of Rural Aid. Welcome, Andrew.
Well, thank you very much, Andrew. When I was at school, there were 4 Andrews in my class. I often find these days, whenever I meet another Andrew, we're all Gen X. I think there was a thing about the early 1970s when we were all getting named Andrew. So a real pleasure being here today. I join with others in acknowledging lands we meet on, and I really extend my thanks to the ANU for this invitation to be here, and I commend the Institute for the work and the study it does in this space. It's critically important. I'm going to cover off on I guess the top points of insurance and disaster mitigation and the like, many of which actually have been heard already this morning. I just want to, though, start by referencing a number of people have asked me about a recent trip that we've just done to the United States. So the Insurance Council of Australia, together with AmCham, led a delegation to the United States, to Washington, DC, and to Sacramento in California. We had senior insurance executives. We had a number of members of Parliament with us, our chairs of our Parliamentary Friends of Insurance. Yes, there is such a group at Parliament House. And we brought with us as well people in the Economics Committee and the state member for Lismore, Janelle Saffin, who's also a Parliamentary Secretary for Disaster Recovery in New South Wales, but importantly, the member for Lismore, and we all know why Lismore is important. We had a representative from NEMA, from the Prime Minister and Cabinet's Insurance Task Force. It was an excellent opportunity to spend a number of days speaking with our North American colleagues, because as the Minister said this morning, this is not just a localised problem, it's a global issue. And I think the interesting thing was both the reception we received and almost the sort of mutual counselling that happened between industry and policymakers from both sides, that they're all dealing with the same problems and what can we be learning from them. I thought it was an excellent opportunity, and we certainly did get to learn a lot because the United States, particularly California and Florida, share very similar characteristics to Australia, both economically. They both have growing populations. People want to live there. They all want to live on the coast. They all want to live in nice areas, but they're all facing into the same problems of experiencing more extreme weather events, building codes that are not up to scratch, land use planning decisions that don't make any sense, and ultimately the economic price that that's all delivering. So as it's been outlined this morning, Australia's extreme weather does impact us all. I mean, the way insurance works, as we know, is that it prices risk. And when it prices the risk, it seeks to diversify that risk across a larger pool. So the premiums of the many are designed to pay the claims of the few. Unfortunately, in the last few years, we've seen a situation where those numbers have not been trending the way that insurers ideally like to see them trend for their own sustainability purposes. And that's really sharpened our focus. So since 2019, since the Black Summer bushfire events, we've had 20 declared insurance catastrophes. An insurance catastrophe is where an event happens. It could be any type of event. COVID, for example, was a catastrophe, but it drives a significant spike in claims. There is an impact to property. There is an impact to insurers, and we start tracking the data. And in most natural disaster events, the Insurance Council steps in as a coordinating body on behalf of the industry in terms of, as the Minister said today, our economic response, so getting on the ground, making sure that claims are being lodged, payments are being made, working with authorities like NEMA and the state bodies on assistance and relief. Out of those 20 events, $19 billion of insured losses have been racked up. So what we've done is in the last few years, every year we track our losses and we report them in an annual report about Nat Cat losses. And you'll see that flood has become, we always knew this, but flood is becoming, and well, has definitely taken the crown of being the most expensive peril to which we try to insure in this country. One of the interesting lessons we learned from the United States is that in Australia, our insurance is very comprehensive. In the United States, it's very hard to get an insurance policy from the private market that covers you for anything more generally than just the usual risks, i.e. A home fire or a theft or electrical shortage and the like. A lot of the perils in the United States through various regulatory interventions have all been seeded into all sorts of pools and schemes and the like. So in Australia, we actually do have a very developed and sophisticated private market for perils. And it's one we've got to work very hard at preserving, because as we've seen in the US, every government scheme that got set up eventually gets wrangled by political persuasions, gets added to, gets eased up because that's politically popular to do. And as the Minister said this morning, it just continues to mask the effect of pricing risk. So in the United States now, for example, there are literally hundreds of thousands of homes that are built on floodplains for which the risk is fully ceded to the federal government's scheme. And the federal government scheme's currently running $36 billion in debt, US dollars. And we asked policymakers over there, if you had $36 billion today, what would you do with it? And the first thing they all say is we would not have this subsidy scheme. We'd be putting that money into resilience and mitigation. We'd be building flood levees. We'd be buying back homes. We'd be making sure that homes were fireproof and the like. And I think that were some of the key lessons that we continue to learn. Some of the work that we've done at the Insurance Council shows that by 2050, the cost of rebuilding, repairing, and replacing homes and contents annually is expected to exceed $8.7 billion. It's a trajectory that we've heard a lot about this morning. And again, from an insurance perspective, what we want to ensure is that we've got a sustainable market so that more and more people can enter the private insurance market to take their cover. The Minister mentioned this morning we're in a perfect storm, and I can just touch a little bit on what that perfect storm means for insurance. Reinsurance costs. Reinsurance is vitally important. Some of us here are old enough to remember the collapse of HIH. That was the largest collapse of an insurer in Australian history. HIH was largely a commercial insurer, but they did obviously have a lot of personal lines. What it did do was it almost ground to a halt the economy for a period of time, because a lot of businesses, a lot of strata buildings, music operators, all sorts of people suddenly had no cover. Post the HIH collapse, APRA, our prudential regulator, really looked at what the capital requirements were for Australian insurers, and the global reinsurance market became even more important, particularly for our carriers of general insurance. So in Australia, global capital has been a critical part of our insurance sector. Very much different to banking and to superannuation, where we've got very strong ring-fenced protections to our local banks and to our local pension funds. Our insurers are very much exposed to the movement of global capital. And the problem with the movement of global capital is that where we used to be an offset to some of the disasters in the Northern Hemisphere, we are now costing reinsurers just as much, because our events are tipping over what the insurers have held in reserve, and so their reinsurance gets called on. If any of you followed the most recent House of Representatives Economics Committee inquiry into the response by the insurers to the floods, you may have seen some of the evidence that was given by the reinsurers. And it was interesting to note what Swiss Re said when they were asked to describe the Australian market. They said, Australia for us is a loss leader. So out of the last 6 years, they've lost money in the last 5 years. And the meetings that we did attend last year in London with the Assistant Treasurer were very instructive, where reinsurers were saying to us then, we've had enough. We have to reprice the Australian market, and we are pricing in what we consider is the risk that faces Australia here and now. So we've seen reinsurance premiums increase between 20 and 30%. Those numbers have started to stabilize. We've started to see global capital markets soften a little bit, although I'm curious to know how things are going after the last 48 hours. But we have seen a lot of capacity coming back to the market, which is good news. But it doesn't mean the rates are going down. It just means that the rate of increase has eased. So effectively, there's been a massive structural readjustment into the cost of home and contents insurance, as well as motor insurance in Australia, and that's flowed through. The second point, which the Minister made this morning, is that a little bit like places like California, Florida, and Canada, we have in the last 50 years moved a lot of people into areas that were never previously habitated permanently with permanent structures. And we've done it really in ignorance of many of the natural perils around them. This is why when we talk about the perils that we want to be able to address from an insurance perspective, we put flood at the top of the list. And it was fascinating to hear the work ANU spoke about this morning. And I didn't mean to look incredulous at the idea of stopping a cyclone or bushfires. But the thing about cyclone and bushfires is we can also engineer our buildings against those risks. And I acknowledge the work of the Resilient Building Council, Kate, who's here today. And again, in the United States, we saw the equivalent of the Resilient Building Council, who are very integrated with government over there and with insurers as an organization that can verify what works and can be used when discounting premiums, as the Minister said this morning. So if you're going to put locks on your house, then we want to know that they're sold by a reputable locksmith. Equally, if you're going to harden your home, it needs to be done to a level that is actually verifiable and will hold true. And so I think that the work that those research bodies are doing are critically important, and particularly now as we try to reach new objectives with the National Construction Code and resilience being a key objective, which I acknowledge the federal government has achieved through the state building ministers, then the partnerships that insurers have with people like the Resilient Building Council and the like are going to be critically important. And of course, we have inflation. And I think one of the problems we've got at the moment is we're having this debate around insurance affordability in the climate of an inflationary environment. Everywhere around the world is struggling with inflation, and Australia is absolutely at the top of the pops because we're at the end of the supply chain. So we've seen that supply chain disruption since COVID really struggled to stabilize. And one of the reasons why is that we've had so many extreme weather events like, the destruction of 2,000 homes in the floods a couple of years ago. All of that adds to the strain on the building system. And we're seeing more and more in regional Australia, it's getting harder and harder to be able to obtain the labor that we need and the materials to be able to do the rebuild in a timely fashion, the way that the customer absolutely should expect it to be happening. So in capital cities, largely we can absorb the shock. But once you move outside those capital cities, and we see that even with emergency responders, when the whole town is wrecked, it's a bit hard to find somewhere to not only put the displaced residents, but also the builders and the electricians and just even the labourers required to clean up the mess. So these are all factors that are now getting counted into the cost of your insurance policy. Home building costs have gone up 27% in the last 3 years. So of course your home and contents policy is trying to price the fact that if the worst happens, the insurers will replace it. The Minister touched on, the cynicism, I guess, or skepticism that exists in the community around insurance companies. You will hear insurance companies return to profitability in the next few weeks. I don't have to be an analyst with JP Morgan to be able to predict that. After a number of years of losses, I'm pretty sure that our listed insurers, and we had a relatively quiet summer, and we've had higher interest rates. Now, when you have higher interest rates, that actually benefits insurers because the premium pools are held in liquid type funds, and they produce more of an investment return. Those investment returns are now fueling profitability back into the industry. But when it comes to our two key product areas, home and contents and motor, they have now historically over the last 3 or 4 years been under the most amount of pressure. So APRA, who our prudential regulator, has estimated that over the last 3 years, insurers have lost about $650 million out of home and contents. Now, some individual insurers make a profit and they do well, but they do well because they've got very strong risk selection for their book. What we do want to make sure is that what we call our national carriers, those insurers that will basically offer a policy anywhere in Australia, are able to turn a profit in home and contents, and we need home and contents to stand alone as a very strong and profitable business. We put up this graph because in fact it shows at the moment that we're making a $4 loss in every $100 in premium. There is one component to your premium that I like to talk about whenever I get the opportunity, which is the state taxes. We call them the forgotten taxes. They are stamp duties, and often duties are levied on things you want the community to do less of, like import goods, so you put a duty on it, like smoke, like drink, alcohol, so they put duties on it. And then you've got insurance, and for the life of me, I think it is a way out of date taxation system in this country, one that should have been reformed probably in 1998 when we introduced the GST, but unfortunately it wasn't. So as insurance premiums have risen because of all these other factors, so too has the state tax take. So all the states across Australia, except for here in Canberra, and hats off to the ACT and everyone living here in Canberra, you don't have to worry about this. You pay a stamp duty. You pay a GST, and then you pay the stamp duty on top of that. If you live in New South Wales, you're even luckier. You get to pay an emergency services levy. So in New South Wales, the average home and contents premium, around a third of it is tax. So if you're paying $2,000, you're paying around $600 in taxes, which means your overall sum insured is going to be less than someone who lives in Victoria or Queensland. And the New South Wales government has acknowledged that, and they're in the process of trying to work out how to abolish the ESL. In Queensland, for example, the Queensland state government collected $1.4 billion in stamp duty from insurance policies last year, which was more than the insurance industry made in profits overall. And while Queensland has some very good leading programs, for example, the disaster uplift fund they do for homes against cyclone, it is not funded to and I can say this because I can, and I want to give more money to people like Brendan Moon. I think more money needs to be directed into those schemes. If we're going to punish people for doing the right thing, we should be giving the money back to the communities in both community level and household level mitigation. So there are a number of things we need to be doing moving forward. Obviously, the investment in public infrastructure, flood levies, and the like are very important. When it comes to household level mitigation, critically important that we think about the village, not just the house, particularly when it comes to convective storms and cyclones and the like. You could have the strongest house in the street, but if the house next door blows to bits, it'll probably wreck yours as well. So we've got to strengthen whole streets. We've got to think about raising homes. We would direct most of the money at flood affected homes if we had the opportunity. That's around about 200,000 homes, depending on whose study you're thinking about. And we've got to cease making the dumb decisions, as the minister called it, moving forward. And Andrew, I was a little bit disturbed. I hadn't been aware of the latest example you just showed me on the Northern Rivers of brand new homes getting built right next door to ones that are under buyback orders. And in Brisbane, for example, we're seeing homes that are under buyback offer they could take a buyback, now selling for $200,000 or $300,000 more than what the buyback offer is. So why would you sell it back to the government? Why wouldn't you go to the private market? I think we've got to join up some of these pieces. So obviously a bank and insurer is providing that person with the ability to buy that home. Maybe we need to have a discussion around what it means, what it really means if your home is marked for an area that requires a buyback. So we're going to be doing a lot more discussion around land use planning. We have a forum coming up in a couple of weeks in Brisbane, which I think is critically important. The construction code, we've mentioned that the need for embedding resilience is a key objective. At the end of the day, insurers price the coming 12 months. So it doesn't matter really, I mean, it does matter a lot, but the reality is we live in the climate we live in now. So I often say to people, I don't care where you stand on the climate debate, the weather is what it already is. And we need to be realistic about it, because if you want to see what the losses look like, we've got them right here. So we need to build homes that are going to last at least 50 to 100 years in the locations in which they're built. It was quite interesting in California. They spoke to us about, they said, I'm not sure if you heard of the Californian bungalow. And we said, yes, we know it very well. You exported the whole idea to Australia. We too are now dealing with that problem. That was the post-war building boom, where homes were built cheaply. They were built on stumps, out of timber and the like. And 70, 80, 90 years on now, they're not quite right for the environments they live in. They're beautiful, but really they've got to either be properly rectified or replaced. So again, a lot of these learnings that happened in the US, we were able to share with our colleagues there. We've got to build on some of these programs. So I think I've got the 97.3 up there, but I do acknowledge what Brendan said today. If there was a way we could get the Productivity Commission to do another study, that would be very helpful, because these things get very much baked in stone. And I don't think it's an and or at the end of the day. This country will always be faced with very high costs of cleanup. Our objective should be how we build stronger, more resilient communities, so that equilibrium is a little bit more balanced. And I think what the Minister said about Australia's got this window, what was actually said to us was we've got a window to get our narrative around our risk resilience right. And I think the more we do talk about the investments that have happened since 2022 in a way that it is about resilience and mitigation, I think it's critically important, and insurers will take note. I think one of the best examples of that are the building standards that we now have in place for bushfire zones. And as anyone who lives here in Canberra, and I was here in 2004 when fires ripped through the western flank of Canberra, the homes that were built after those bushfire events and down on the south coast in 2019, 2020 will likely withstand future bushfire events. So we are, through some of these disasters, building back homes better and stronger and more insurable. If we think about Darwin, one of the things that came out of Cyclone Tracy was that the whole town was rebuilt to a whole new standard. And Darwin's had several Cat 3 and 4 cyclones pass near it or over it over the last few years, and largely the wind damage has been relatively minimal. So we do have the technology, we can do it right, and it's just a matter of us finding the political will, the collective community will, to be able to support the investment that's needed to make Australia a much more secure and insurable place moving forward. Thank you.
Thank you, Andrew. I'm now going to call on our next panelist, Paula Jarzabkowski. Paula is a professor at the University of Queensland. She is a global expert in the public-private mechanisms proliferating around the world to address the disaster insurance protection gap. Currently, Paula is researching how we can transform the insurance market to be a partner in adapting to climate change, including how innovations in disaster risk financing and risk pooling can be linked to property resilience measures to support climate adaptation. Paula's expertise is widely recognised as a member of the OECD High-Level Advisory Board for the Financial Management of Catastrophe Risk, the Lloyd's of London Future Set Technical Advisory Group, and the Pool Reinsurance Company Advisory Council. I also recommend, and she's not going to market her book, but she also, or actually it's on the front page of the slide. She also has a great book. There you go, Paula.
judge this book by its cover and what's inside it. Is this working? Yeah. Great. Okay, so I'm going to talk a little bit to some of the things that have already been raised this morning very well by the Minister and also by Andrew. So thank you very much for setting the stage. I'm hopefully going to give you a crash course in Insurance 101, which will put a framework for you to understand a lot of the material that's come out. Now, some of what I'm going to talk about today is indeed from this book, which we released last year, which looks at 17 public-private collaborations to address the insurance protection gap operating in 49 countries around the world. So there's a little bit of substance behind what I've got to say. So first thing is, I think we already are pretty aware from today and from any headline you look at that disaster insurance is in crisis. You can't actually open a paper without seeing stuff like this. Now, I want you to understand that this is a problem because, as the Minister said, it's not just about price gouging or all these things. Insurance is not a dirty word. Insurance is, in fact, a very key way that we recover from disasters. We even know that highly insured countries can have a spike in GDP after a disaster because it replaces old technologies and old assets with new assets through global capital. So we know that insurance is not a dirty word. When it works, it does a lot of good for us. We also know that those countries that do not have insurance struggle much more. And this is worrying me because increasingly Australia, an advanced economy, is becoming one of those countries that has rather less insurance than we might take for granted that it does. And you've heard this 1 in 8 or 12% households. Thanks very much to the Actuaries Institute for that piece of work, which has given us one way to think about this. I'd also like to point out, and I know that Caroline will deal with this a little more afterwards, is that we know that when we can get higher levels of insurance penetrations, we allow those in vulnerable economies to bounce back better. And I just want to show you a little bit of the kind of challenge. I did a bit of a savage chop on this graph so that you can see the side of challenge we're facing in here and trying to get insurance levels up to something meaningful to help us deal with this situation that we have in fact created for ourselves. Okay, so let me talk a little bit about, everybody's talking about why has insurance gone up. Here's a little graph or heuristic that any of you can use to talk to people about it who may not understand. So the first thing is we've got all these Australians who are at risk of bushfire, flood or cyclone. So what they do is they take out an insurance policy. Now, the problem is increasingly because insurers are regulated, they need to show that they're collecting the right amount of capital to reflect the risk they take on their books. So the more people we have at risk and the more that you are in an at-risk area with your home, the more that the premium you get charged will reflect that risk. It's called prudent actuarial practice and it's known as risk reflective pricing. So those of us who've had a disaster happen to us will see our premium go up because we are more at risk. And we're pretty familiar and comfortable with that in things like motor insurance, where we're happy to see that maybe younger drivers, who are more likely to have an accident, get charged a bit more until they show that they can manage their risk better. So it's not something that's that unusual. The other thing we've heard, and I want you to think about insurance as a big wallet. Maybe that'll help think about some of these things that have been talked about this morning. If you think about a big wallet that's got to pay for all the losses in Australia, so that insurance wallet is filled up with premiums through the different insurers. But the more that they then have to pay for losses from all these disasters that Brendan's beautiful graph showed us, that are increasing in the amounts that the loss that they make for Australia, the more that has to be paid for out of that same wallet. Now, what do you do when your wallet runs down? You have to fill it up. And if you've got to pay for more and more losses from that, you need that wallet to be filled up with higher premiums. When we put that alongside the demands for solvency in the face of climate risk, the inflation, the rising costs, and we keep in mind that insurance is a promise. It's what's called a promissory note. It's a promise to rebuild you at the time that the disaster happens to you. In the costs that it will be at that time to do the rebuilding, it has to factor in the fact that those costs are going up so that it can keep its promise to you. I'm actually pretty good with that. We've seen what happens when banks took money that they really shouldn't have taken at the rates they were taking. I do want my insurer to take my risk at a price it knows it's going to be able to pay my claim. So that in itself is not a bad thing. That's a good thing. Then we have to say, well, okay, now there's this big global wallet that everybody is also talking about, the reinsurance wallet, and it's paying all the losses around the world. You heard today that Australia is a loss leader. Okay, so actually we're a pretty big drain on that wallet. So they're going to need to do quite some work to turn it around so that we're seen as the good kids drawing on that wallet. So just to think about it like this is part of the problem. And then let's put another whammy in there. Insurance is about modeled risk. If you can't model the risk, you can't get a good price on it. Studies have been shown that, for example, some of the, industry-linked securities and things, the catastrophe bonds that have come in, they actually add a bit more for an uncertainty factor. So the better you can model it and show it, the more that your price will reflect the risk. If you can't, if you have this uncertainty, there will be an uncertainty factor also added in. And it has to be said that we are in a time in which climate-driven uncertainty is adding that factor in. So what is the outcome that we see in Australia? We see many uninsureds. Okay, uninsureds are those who literally have nothing to put aside for a rainy day. We have those who style themselves self-insureds. I sincerely hope that they are, because that means that they have taken some calculation on the risks that they face. And while they are not buying insurance, they believe that they have the money to make good afterwards. Because if they don't, what we end up with here is people with no post-loss funding other than what we as a government can provide for them. And we, the government, we, the disaster fund, is we, the people. So that's us. And I'm glad we're a compassionate society and we continue to do that. But it does worry me when I know that already 1 in 8 Australian homes is in that situation, and possibly more. Because if we think that it's 4 weeks of gross household income that makes you one of these 1 in 8, then I'm thinking most of us would probably think, I can't even come at it if it's less than that. Okay, so we are definitely facing a problem. Let's not understate that fact. So what can a government do? When things are no longer insurable in the private sector, they can create what we call a protection gap entity. We call it that because some are public sector, some are private sector, and some are a collaboration, but all of them have been put in place to deal with a protection gap for disaster insurance. And what is one? Well, here's an example of one from the UK, and it gives you something of an idea. People often like to put moral imputations on those who are uninsured or underinsured. They are not looking after themselves. They are a drain on society. However, when we see these, and these are very realistic kinds of prices, where 10% or more of your household value is what you would be charged for a meaningful premium, then we would say that that's not a moral problem. That's an economically rational calculation. You can't be insuring your house at more than 10% of its value every year. So when we have such a situation, we do have a need for something to be done because the market doesn't work. Now, there are many things, and I'm going to talk to you about 2 sides of those things. But the first thing is that what a PGE will do is it will come in place to address the affordability and the availability problem. Okay, so we've heard a lot about how we shouldn't subsidise insurance. These are just some of the many PGEs that we have looked at around the world. We've heard that we shouldn't subsidise insurance because that's a bad thing. It masks the risk signal. I'm not disagreeing with that. I hope I can show you that that doesn't have to be the case. But at the same time, at the moment in which people can't get insurance, being able to get insurance certainly makes a difference to those people. So we have to accept that policies have pros and cons. Let me show you what a PGE does. You can have an insurer PGE where the insurance sector takes your premiums, and if it's a comprehensive one like we have here in Australia, then it takes your premium for everything and it passes the disaster component to an insurer PGE. That's what Toka Tu Ake in New Zealand is. It's an insurer PGE that's been operating since the 1940s to provide the earthquake component of insurance for all New Zealanders. So that's one way we can do it. The other way we can do it is we can say the insurers take the risk, but they face this problem in the global reinsurance market that it costs them a lot to displace the insurance part. So what they can do is create a reinsurer PGE, and that's something like what we have for terrorism with the Australian government, ARPC, and it's what we now have in a certain way with the cyclone for ARPC. So you can create these different ways in which a PGE can work within the risk value chain to change that problem. So let me talk to you a little bit more about what does it actually do. So there's a strategic response protection gap framework that we developed. I think you'll actually find it also been drawn upon for the Australian Insurance Terrorism Act of 2018, I believe. This model appears in the appendix. So I'm not going to talk to you about removing risk, which is one thing you can do. You can just take risk away and put it on a government balance sheet. If you don't do that and you don't do anything else, what you've got is no response. I believe that in Australia at this moment, we have no response except on terrorism and to a limited amount cyclone. Okay, we know there's a big protection gap. I've heard a lot this morning about the things that are being done by the Hazard Insurance Partnership, and the Minister referred to the fact that this is being dealt with. So I'm very excited by that, because at the moment we don't have it, but it looks like it's imminent any moment now. Let me show you some of the ways that we deal with the kind that we're talking about at the moment, which is this problem of more and more people at high risk within society. One of the things you can use, and this is the one that many people criticise, is you can redistribute risk across the population. So you can make the whole of your country into a big mutual. This is largely what New Zealand does with the Earthquake Commission. And that means that keeps you, or those at higher risk are being subsidised by the premiums of those at lower risk to make sure that everybody stays in the insurance net. Okay, so what it is very good for is smoothing price for those high-risk areas. Clearly, it is problematic when we get more and more high-risk areas. It won't stop the high risk. All it'll do is subsidise so that those at high risk at least remain in the protection net. The other thing, and this is the criticism that I think has been made by both the Minister and I think others have referred to it this morning, is it can shift attention from risk mitigation. If I have insurance, do I need to bother about risk mitigation, or does my government need to? So I'm going to talk to you a little bit about that, because that's the one that's the biggest bugbear whenever we say we should do something about insurance affordability and availability. We say, oh, but that's not fair if we subsidise people. It's called moral hazard. Those people are at high risk, probably through some bad decision of their own, and therefore we should not be subsidising them. It's not fair. Okay, I actually agree with that. If you put in place a PGE, and it means that people don't have to change their risk and they can stay where they are and they can keep being insured. And as Andrew pointed out in the US, you can keep rebuilding on floodplains like for like, then you are definitely creating a moral hazard and taking away the incentive for mitigation. So I'm not disagreeing with that. But I just want us to think about the old not fair story here. So just a quick story. I could have told you this story from anywhere in the world, quite frankly, at the moment in an advanced economy. Let's just use Townsville for now. So here's the Good Shepherd nursing home. Its premiums increased to $670,000 per annum after the 2017 floods. Now, aged care, that's capped, so you can't just keep increasing the price of the aged care to cover the cost of your insurance. So all you can really do is use your aged care money to pay the costs of your insurance, which means you've got to take that care of those aged people out of something else, right? You've got to take the cost of your insurance away from doing some other form of care. So my question to you is this the problem we have? Are these the free riders we have? Because I don't think of my mum and dad like that. They've passed away, God rest their souls, and thank God they're not here to see this. But my point is, we need to move away from naive, unnuanced discourses about fairness. So what can we do? I'm going to ask you that question. I'd love it if you could tell me who should pay and how should we pay for this, and that's the point of today. But let's talk about whether we can make it fair. Is every PGE a bad thing that masks a risk signal? Let me show you PGEs that have been around for decades. I'm going to show you one that's been around for over 100 years, and it has 90% of its market, and it takes all of the disaster risk. It's the Swiss system. When you take every bit of risk over many decades and you pay every claim and you are not allowed to not take that risk, you are required to insure them, you get to know an awful lot about exactly what your housing stock is, what it's built like, and how it stood up to every disaster. This gives you a powerful incentive. First, to build back better, to mitigate loss. We hear a lot about this, and that is indeed what they're doing in the UK. And that's a good thing. Let's put in place at least a risk pool of some sort of PGE while we change the underlying risk and use those claims to change that underlying risk. That's one thing we can do. I'd like to say that's not enough. And this is why I bring in this Swiss system. You see the 3 parts of the model, and those 3 parts of the model speak to the 3 things it sees it does. It does prevention, it does intervention after disaster, and as a final point, as the afterthought, it does insurance for residual risk. And that is the point of this system, which has grown up over more than 100 years, which is it does an integrated disaster response after loss. So if you can contain the disaster immediately or as quickly as possible, you will get less loss, which means less that you have to pay for to cover up. We actually also see this in the Netherlands. While it doesn't have this system, the insurance sector pays for the disaster response. We also then see that this is integrated in designing infrastructure. You know which infrastructure actually exacerbates your problems, and it's integrated in, these are the construction standards that will allow us to have buildings that are resilient and withstand loss. The other thing it does is it brings that knowledge into developing the risk maps and integrated into the land use planning, including the zoning of areas where people may continue to live, but those properties may not be resold. And if you look at it, here it is. Here is insurance knowledge being used. If I have to take the risk as the insurer, I should have rights to say what prevention measures. So if you want to build, you have to first go through the insurance mechanism to get your permissions. Now, all of this, of course, works because it's been around a very long time. And during that time, they've worked out an enabling and joined up government framework. And in fact, I love to see this. That is actually our responsibility to bring about fully integrated risk management. So I was very excited this morning because it seems to me that that is where we're going in Australia. And that's great because that is what we need to do. At the moment, we tend to see resilience as some sort of back to normal or slightly incremental changes, very separated from the overarching financial system. Most insurance here is still build back like for like, not change the dial. So if we want to move into from maladaptation to climate adaptation, we need to do some of the things which, you know, are falling under these disaster risk reduction schemes. And I'm grateful to both the Queensland Reconstruction Authority and Natural Hazards Research Australia, which have given us the opportunity to evaluate the Resilient Homes Fund being rolled out as buyback, retrofit, raising, flood maps and community engagement in Queensland. Hopefully we'll be able to tell you a little bit more about those resilience measures and what they might do. Nonetheless, I would say to you, this is still separate from the finance system in Australia. So we've got a resilience system here, we've got a finance system there, which is insurance, and the two are not talking to each other much, although thank you to some of the insurers who have agreed to come on board and support us in the work we're doing with the Resilient Homes Fund to see how that might change the dial. So I'm grateful for that. But what I'd like to suggest to you is that the holy grail we need to find in Australia, and I hope we can do it, and I was optimistic hearing from both the Minister and Brendan this morning, is that we are trying to do this thing, to join the financial system and the resilience system. This book is free. I got a grant from the European Union to make the e-copy free. If you'd like a copy, I'm selling nothing other than dreams of a better future for Australia.
Well done to Paula. Thank you. I'd just like to introduce Carolyn Schuster as well. Dr. Carolyn Schuster is a senior lecturer here at ANU in the School of Archaeology and Anthropology. She's a specialist in gender equity, entrepreneurship and economic development, having spent 2 decades engaged in on-the-ground fieldwork with marginalised communities in Latin America. Her research on microfinance and microinsurance uncovers the complex social and cultural forces that shape how local people engage financial systems. So welcome, Carolyn.
Good afternoon, and thank you all for sticking with us until the last presentation of the day. I'd like to join my colleagues in acknowledging that we're meeting on the lands of the Ngambri and Ngunnawal people, and this has long been a site of learning, and extend my respects to First Nations colleagues joining us here today in dialogue. Thanks for that. As noted, I'm an economic anthropologist here at ANU, and since 2005, I've been researching microfinance, focused specifically on whether it delivers on its promise of gender equity. And my long-term fieldwork has been with inclusive finance in Latin America. I'll draw on some of those lessons learned to bring them into dialogue with the Australian case. More recently, since 2017, I've focused on microinsurance for weather disasters, again in Latin America. As an anthropologist, this means immersive fieldwork, working as a field hand on farms, in agricultural cooperatives, shadowing insurance agents, and in the financial inclusion desk of the Paraguayan government. As an ethnographer, I was on the ground in country for about 14 months for this project, and during an El Nino year to boot. One really important insight is that the connections to microfinance run deep. Almost all microinsurance products for low-income communities are bundled with credit. Insurance policies may well provide a crucial tool to face climate-related environmental harms, but this comes in the context of communities that are depending more and more on credit to survive, and that wider context is something that's really important when we think about financial services broadly. This has profound and troubling implications for gender justice in disaster risk management. As anthropologists and economists agree, I know, a rare cross-disciplinary consensus, that women in Latin America tend to access credit on more unfavorable terms. And my 2 decades of research note that policies that may on the surface appear to support women often make deeply damaging assumptions about gendered home responsibilities, obligations to care for kin, and gendered norms about women's self-sacrifice. So financial inclusion offers challenges as well as opportunities to do better. So the rise of microfinance comes in the back of 3 decades of financial inclusion policy, which is why I think it's important to link insurance to this wider suite of financial services offered to low-income communities. For Australia, recognizing this nexus is important, I think, for 2 reasons. Migrant communities are reliant on these financial services in home countries, both to fund migration and through remittances. And second, we can take lessons about inclusive finance, which is long established its ties in the global South, and avoid some of the mistakes and pitfalls by observing already existing programs as we think about the insurance gap in Australia. The most comprehensive data on the global microinsurance panorama is provided by the Microinsurance Network, led by Munich Re, another one of those titans of reinsurance. You can access their annual reports online, and these are particularly useful for the primary data they collect from nearly 500 insurance providers globally. The most recent data suggests that life and credit life continue to dominate the insurance sector in the global South. And the most important product lines in terms of people covered were those 2 kind of areas, and about 80.7 million people kind of covered. Thinking specifically with disaster risk insurance, with the inclusion of this year's data on the public-private crop insurance scheme in India, covering almost 28 million people, agricultural microinsurance became the 3rd largest product line in terms of people reached, in contrast to its 7th position the previous year. It also became the line of business with the highest recorded premiums, followed by life and then credit life. Insurance for disaster-resilient food systems is an important part of this picture. And it's important to note that the agricultural insurance schemes frequently benefit from government subsidies. So going back to kind of Paula's points just now, a total of 11% of the agricultural schemes recorded in the study were fully subsidized, the highest proportion of any product line by far. More likely, more benefit from partial subsidies, so that information isn't widely collected. And this insight aligns really closely with my research on the ground in Paraguay. The drought insurance policies that I tracked weren't subsidized directly. They were offered by one of the private national insurers and marketed through a local agricultural cooperative, who made insurance a condition of agricultural credit for their member farmers. But the pilot project received seed funding from, at the time, AusAid, I know, a blast from the past, and FOMIN, the Capital Fund for the Inter-American Development Bank. So without multilateral aid, the expensive weather stations, climate modeling, consultation from agrometeorologists, and marketing would have blown out the costs and made the projects a non-starter from the start. So now I'll speak briefly to some of those weather perils and how they're insured in microinsurance. As we've just seen, crop insurance schemes are growing quickly in popularity, and weather-linked policies are responding to the increasingly uncertain conditions caused by extreme weather events. Parametric policies are at the center of these debates. So a recent review shows that low and middle income countries, more than 80% of recently insured farmers are covered by IBAY policies, that's index-based agricultural insurance. As a brief primer, these policies use remote sensing, historic weather data, climate modeling, and specific weather parameters to trigger an insurance contract. So this is distinctive and quite different from indemnity insurance. The core of this is a weather index. So rather than conventional claims adjusting, parametric policies have the advantage of triggering payouts immediately. As soon as a weather event occurs, the index is triggered and the policy pays out. There's a lot of technical challenges in this insurance space, given that microclimates and highly localized meteorological conditions are incredibly important for agrarian communities. It means that, especially for smallholders operating farms of less than 10 hectares, the data often isn't granular enough to reflect so-called ground truths. This has two disadvantages in this space and speaks to some of the social kind of equity issues that are at the heart of my research. It can lead to inequitable outcomes for specific policyholders, but more broadly, we risk the general perception of arbitrariness or unfairness that can shake confidence in microinsurance kind of broadly. So for instance, local variance in weather outcomes that were misaligned with the wider weather model led farmers in Paraguay to conclude that, in their words, someone was eating the money, suspicious that corrupt officials, either in the local ministry for agriculture, the insurance company, the cooperative, that somebody had seized payouts that had duly corresponded to them. So on the surface, the index insurance kind of seems like an elegant and transparent technical solution to providing crop insurance for farmers. But it faces complex interactions in terms of uptake. And this is a theme that I'll return to again. Without understanding the economic situation holistically, embracing high-tech solutions that bring down premiums and promise inclusive protection can, one, be more costly in the long run if we don't think about how insurance interacts with local realities, and two, may actually damage the crucial social relations that are so vital to social cohesion and collective responses to climate pressures. So what does this actually mean for farmers? The technical practice of converting the multiple and overlapping environmental challenges faced by farmers to a quantifiable index means that the actual protection provided by parametric policies are limited to a small number of perils and that may insufficiently be attuned to the particular socio-ecological challenges of any given farm. So these IBAY policies, though quite popular, tend to be confined to specific households and regions and cultivating a really specific select group of crops. And even when the IBAY policies exist, women in poorer households are often excluded, often because of normative expectations that skew land titling towards men. So the introduction of IBAY in such socioeconomically stratified landscapes can actually exacerbate inequalities. My key point here is that we need to balance the technical promise of weather-linked insurance with social and environmental impacts. We can't just look at the quantitative data to assess those outcomes. And as a side note, some of these images that you've seen are from a broader project I've been working on with collaborators in Paraguay to produce a graphic novel about our research outcomes. So if you want to learn about how a social scientist might turn into a comic book author about insurance, I'm happy to talk about that in Q&A. So insurance isn't just kind of responding to environmental risk. In many cases, it might be actually causing those risks. For example, the farming practices incentivized by insurance can erode biodiversity, lock in unsustainable land use, and increase dependence on agrochemicals and commercial seed varieties. And this in turn can devalue traditional environmental stewardship practices, in part because the policies are fixed to those really specific crops and are based on kind of weather modeling that happens at a distance. So as an example here in Paraguay, it locked farmers into growing one cash crop, the insured one, sesame, for export on the world market. This increased their exposure to price volatility and made the ecosystem vulnerable to the problems raised by monocropping. So fungal diseases led to widespread farm losses, and made farmers also highly reliant on pesticides, herbicides, and other chemical inputs to manage and mitigate those fungal problems and deal with an unfamiliar crop that was largely alien to Paraguayan foodways. It's non-native and grown strictly for commercial export. And what of the benefits on the flip side? The coverage of parametric crop insurance didn't actually help rural communities weather the impacts of a disaster like El Nino droughts. The payouts covered the cost of planting and kind of managing those farm inputs. And because the payouts that they did receive pretty much flowed back to the financial kind of institution as portfolio level risk mitigation strategy for their lenders. Farmers might not sink deeper into debt, but this was not actually a forward-looking adaptation measure for robust and resilient food systems in rural communities. So without careful management, insurance products can actually expose vulnerable communities to new and unintended risks. Again, this is not to say that insurance has no place, but parametric policies aren't a silver bullet. When we're assessing the outcomes, we need to take a holistic approach to really understand the social impacts. And in addition to affordability, we should consider community dynamics as a fundamental component. So to wrap up, I want to talk briefly about the informal insurance that has long existed in parallel with newfangled kind of policies like parametric insurance. As you can see from the inclusive insurance panorama, most of the Global South does not have access to formal insurance cover, and this is a problem, as Paula alluded to. And where they do, the benefits flow mostly upward to financial institutions and not forward to resilience and adaptation. So there's lots of community resource pooling kind of strategies that are existing in parallel to formal insurance. One way to think about this within a broader set of strategies is to shift the unit of analysis. Rather than focusing on individual consumer policyholders, we can look at other social institutions and relationships. This includes savings, pensions, remittances, informal loans from family members, or other kin and household-based collective investments. Faith-based communities play a really crucial role in disaster recovery, particularly in the Pacific, and overlooking their role can miss really crucial dynamics in terms of resilience and adaptation. So for example, discourses of blame and responsibility take on a really different meaning for Christian communities that interpret disaster through the lens of divine judgment, rather than insurance kind of actuarial frameworks. In anthropology, we call these moral economies. We can't understand decision-making if we don't understand those wider value systems. As a brief example here from a webcomic that I've been working on, like insurance, which has the unintended consequences I've noted, community resource pooling can also have unintended consequences. We show how long-standing interethnic conflict in rural areas was amplified while financial services were added to the mix, especially when insurers relied on local elites and politically connected actors to gain market access. Those social hierarchies predated inclusive insurance and posed wider challenges to collective climate responses. So to conclude here, further research is needed. Further research, particularly on approaches to climate financing adaptation and disaster response outside of the mainstream insurance, could complement what we've been learning today about insurance solutions. And these alternatives often are more sensitive to localized, culturally specific, and faith-based responses. But we should take care to understand the risks of social marginalization, social conflict, and the added burdens to already vulnerable groups when relying on community-based resource pooling as an alternative to individual insurance cover. Thanks.
So we'll have about 10 minutes for questions. So I'll just ask our panelists to come forward, and just in the essence of time, just keep your responses, if you can, relatively short, so we can try and get through as many questions as possible. Also, just while the panel is coming up, just been reminded that the recording of today's session will be online after today as well, and the same with the presentation slides as well. Any questions in the room here? Ray, you've come in real quick. Go, mate.
When I was at COP28, I actually met with a number of people from Africa and other countries about sustainable insurance. And a little surprising to me, if I said, what's the one thing you could get if you could get something? And it was actually expertise. It wasn't money. It was like, I think there's something like 65 actuaries in Kenya. And they said, you know, we just don't have people that can do the work and roll these products out. And I was just wondering, maybe that's something Australia could export, because we do export education, and maybe get tailored programs to educate people in these countries in risk management. I'm just curious what you think about that.
Yeah, it's a great insight. And one kind of common refrain in Paraguay while I was doing this field work, kind of bemoaned by everyone from the Central Bank of Paraguay to the ratings agencies and insurance companies, so there was not a single accredited actuary in Paraguay. So the kind of fundamentals were kind of certainly not there. That said, one kind of really interesting thing about these synergies between the global financial inclusion kind of panorama and organizations like Munich Re that are working really hard in kind of building capacity around kind of financial inclusion, especially for microinsurance, is that a lot of that sort of expertise and the modeling is there. Australia has it. There's lots of established kind of models. What we don't fully understand is how that interacts on the ground. So if there's a kind of alternative set of moral claims, value systems, political dynamics that reinterpret what seems like a straightforward kind of risk management framework and filters it through an alternative lens of values, you're actually could end up amplifying problems that you don't even know you have yet because that information is not there. So I think what we're really looking at is the need for important synergies between on-the-ground expertise in country from kind of Paraguayan or kind of Kenyan kind of social scientists and experts in insurance who can do some of that translation work to make sure that the models are well adapted to the on-the-ground conditions.
Thanks, Carolyn. Thanks, Ray. I've just, whilst I'm seeing another hand in the room for the microphone to go to, there's a question online here. It is for Andrew Hall. What, in your view, have we learned about the impact of the cyclone reinsurance pool now that it has been tested in far north Queensland?
It's still early days. Not all insurers are yet fully in the pool. The smaller ones have until I think the end of 2025 to move into it. Most of the large ones are already there. Initially, what we've seen is some of the very high-risk properties that were struggling with availability, particularly, for example, in Townsville and Cairns, older strata buildings on the Esplanade and the like have been able to access policies again, and they are seeing some discounts. I was up in Cairns last week and met some people who saw their insurance reduced by about $300 as a result of the pool. But the problem is then it's gone up anyway because of inflation. So I've had to keep explaining that even the rate inflation is running at the moment. It's outstripping the benefit of the cyclone pool, but nevertheless, on an availability front, which is where the issue was, insurers are back offering policies in areas that they were adverse to offering previously because of the risk.
Right. Thanks, Andrew. We've got a question over here.
Hi. Yes, I had a question for Andrew again. We've heard from some of the speakers about the importance of price signals for micro adaptation that households can do to help with their insurance costs, and those price signals feeding through. I'm wondering if you could speak to the barriers for the insurance companies in incorporating those kinds of micro adaptations into premium costs, and are there things that would help to surmount those issues?
The one thing I'd say about micro adaptations, with all respect to the Assistant Treasurer this morning, is that $50,000 to fireproof your house is not a micro bit of money. The average cost of the resilient building, resilient home fund in Queensland is around about $16,000 to $20,000, I think, per home. And what we're finding is that even where, so for example, the Bushfire Resilient app, which we worked with on the Resilient Building Council, and we've got insurers offering premium discounts for completing the app and being able to demonstrate that they've done verifiable resilience work. They're getting feedback through their customer channels that the quotes are coming in $10,000, $20,000, $30,000 to do it for a $500 discount. So it has a lot of commonality, I think, with the energy debate and the cost of solar, for example, now and the like. It kind of leans towards the fact that where we can identify what needs to be done to be able to reduce premiums, quite often in older homes, older building stock and the like, it does require a public-private partnership. It does require some taxpayer dollars, I think, to be able to make it affordable for the consumer to do it and to get the recognition.
We have time for one more audience question just down the back there for the microphone. But in the meantime, I have a question for Paula from online. Renters are often sidelined in conversations about insurance, where premium costs are passed on from homeowners to tenants. Is there anything being done or in your mind could be done that centres on renters in the conversation?
Yeah, I think this is a really important point, actually. And one of the things that we're looking at in work package 1 of our Resilient Homes Fund study that we're doing, we've been looking at these kinds of initiatives in different countries where they've, what incentives are they using about reconstructing houses, changing the nature of the housing stock. And some of them have some very specific incentives to support renters remaining in communities. I think it's something we probably haven't looked at enough in Australia, given that rental populations constitute part of our employment base and things like that. So we're hoping that we can feed something into that because it's not very strong yet.
Right. Thanks, Paula. Our question there at the back.
Thank you. And I won't say exactly where I'm from so I don't get in trouble. But Paula, on some of your reactions from what Andrew said about Australia being a loss leader and the question you posed to the group about who should bear the costs of disasters, should our strategic goal be attempting to be a loss leader in global capital markets as long as we can, so we have some of that sort of buffer against losing the capital in Australia?
I think it would be great if we aimed to integrate our financial system with our disaster resilience system so that we ended up not being a loss leader, but being the jewel in the crown. I do think that's a long-term proposal, but we could start working for it right now. So, being a loss leader is not going to be a viable position for us going forward. We already see the effects of that. I'd strongly encourage us, though, to work today at integrating those things, not leave it for the future.
And then yeah, choked her up. I think the other point is that a loss leader, someone's to the whole point of today, someone's paying, and really all roads are leading home to right here in Canberra. The taxpayer is picking up the bill for that loss leading, that protection gap. And I think that's the fundamental challenge that our federal government has got in our beautifully federated system, is that you got all these states collecting all this tax and taking the GST, and then the insurance protection gap is just sheeted home to the federal government to pick up.
Okay, I'm going to wrap us up now. We are at time. Our conversations will continue, no doubt, outside. I want to congratulate ANU firstly for putting on a fantastic event and bringing together diversity of minds. As we always say in NHRA, it's about the diversity of people that we can bring together in a room to crack and solve problems, and ultimately through research to generate that evidence base to inform future policy decisions and actions to build a safer, more resilient and sustainable Australia. So thank you for ANU on putting such a great event together. So a round of applause for the ANU and for everybody coming out today.